So I wanted to make a quick video just simply breaking down why I don't trade penny stocks, why I avoid penny stocks, and why I believe most individuals should avoid even looking at penny stocks. However, I do want to provide a quick disclaimer that yes, just because I don't trade penny stocks and I believe most people shouldn't trade penny stocks as well, it doesn't necessarily mean that you can't trade penny stocks and that you can't be profitable. Of course, you could be profitable trading any stock in this market. However, I'm going to go ahead and break down why the possibility or chances of you actually being successful with penny stocks throughout a long stretch of time is very unlikely. And I'm going to go ahead and break down my reasoning behind this. Now, first we have to define what a penny stock is. Now, many individuals believe that a penny stock has to be trading for pennies, but that's actually not true. For example, we're taking a look at ticker symbol KNW. It's a stock called No Labs. I've actually never heard of them before, and they're trading for around 24 cents. So yeah, it's trading for pennies, but you could still have a stock trading at $5 and below and still be considered a penny stock according to the SEC. For example, if we take a look at ticker symbol SPCE, this was a stock that I talked about a while ago during the pandemic, saying that this was a stock that most likely was going to become a penny stock. Of course, during the pandemic, it hit a high of $62.80, rallying up tremendously, but you have to also remember what happened during the pandemic. Well, we had easy money with these fiscal policies as well as monetary policy, just providing a favorable environment for small cap stocks where they rallied up. But once reality started to hit, once we started to see things kind of change in the landscape of the economy, well, we ended up seeing SPCE, as I called out, becoming a penny stock by definition, where now it's trading at $1.57, becoming basically a worthless company. Now, another example would be Lucid. This is another one, another EV car company where during the pandemic did extremely well, hitting a high of $64.86, but since then has fallen down tremendously, where now it's trading at around $4.97. So it's teetering around the name of being a penny stock. Of course, in the next few days, if it goes up to $5.30, by definition, it's not really a penny stock, but it's pretty much teetering on there. Now, I do also want to say that just because something's a penny stock, it doesn't mean that it's going to stay a penny stock forever. There are, times in the market where penny stock companies have became great companies. For example, let's go ahead and take a look at AMD. This is an example that many people love to throw out there when it comes to a penny stock, and I'm going to go ahead and show you the reason why. So if you actually take a look at AMD, Advanced Micro Devices, we see that back in 2015 and in 2016, this was a penny stock trading for $1.61. And if you fast forward, go 2017, 18, 19, 20, 21, 22, of course, this got out of the realm of being a penny stock and is now something that actually has volume and is trading at around $98.07. Now, I'm not saying that a penny stock is something that is always going to be worthless. There are some exceptions where some companies actually start to succeed and get out of the realm of being a penny stock. The likelihood, though, is much more smaller. And so one of the things you often see is individuals say, well, I want to get in early, so I want to buy it when it's a penny stock. But the fundamentals aren't really there to really highlight that this is a company that's going to do well. And most of the time, these penny stocks are just companies that are IPOing just to raise capital, but they won't really make it much farther than there, and they end up staying as penny stocks and may even get delisted. And the chances of this actually happening with AMD are very unlikely, with other companies. It's not like this happens all the time, but of course, people love to see the one exception and make that the rule and say, well, if AMD, happened like this, well, maybe this penny stock. And that's just not the case. Now, one of the other reasons why I try to avoid penny stocks, and let's actually go back to looking at a penny stock like KNW, is that oftentimes they have weaker fundamentals and less experienced management, and that's the reason why these penny stocks don't do well, right? They don't actually get out of being penny stocks because the fundamentals are just terribly weak. And of course, why do investors, or market participants rather, pour money into a stock? Yeah, it may be just based off the technicals if you're a short-term trader, right? But investors, they put money into a stock because they want to see a return on their capital, and they're looking at the fundamentals. They're looking at these financial ratios, and these penny stocks just don't have that financial data that supports even justifying putting capital in these risky investments. In fact, if you go ahead and you look further back, you'll see that a lot of these penny stocks pretty much just continue trending downwards for a long period of time, for years. In fact, we're looking at KNW, which I showed in the beginning so far in this video, but we could look at countless examples. I mean, if we take a look at DRYS, dry ship, I mean, look at this. It's just trading sideways, basically with no volume. And I'm sure if I zoom out, you could see this is something that has just been falling for years. I mean, just for years. I mean, if we look at this 2008, and that's really the case. And so I try to avoid stocks that just have this downward trend of going down for nearly a decade. Now, is it saying that you can't be profitable? I'm sure that, again, someone could probably do a day trade with KNW and make a nice return. If someone day traded this from right over here to here, yeah, 6% return in just a few minutes. And yeah, there is a chance of being profitable, but you also have to remember that there, are still risks with trading penny stocks. Even if you don't invest in penny stocks, trading them still holds some risk, right? And so let's go ahead and talk about some of the risks. And that's just really being that they have a lot of volatility. There's rapid gains and rapid losses, and oftentimes that volatility can encourage riskier behavior because of just emotional trading, and it just pretty much leads to poor decision making. And of course, another reason why penny stocks are generally just bad is because they're often more times involved in pump and dump scams, which are actually illegal, where you'll have maybe you'll be an individual. You'll see some individuals maybe having a large trading group, and they'll tell everyone to go in and buy on the stock because they have some hot tip or they see a mini catalyst event while they're already invested. And let's say someone already bought in for this stock at KNW right around over here at 22 cents, and they end up telling their stock trading group or whatever, hey, this is something that's going to go up, and then they have other individuals pour their money in, and then from here they just slowly start selling and pretty much scamming the people they told to invest in these a stock like this. And that's actually illegal. That's a pump and dump, and that's actually more prevalent with these penny stocks. It's not going to be something that you're going to see on a large market cap stock like Apple or Tesla or Nvidia, as you would need a lot of capital to actually even put a dent into those stocks, right? Because they, again, have a large amount of volume. They have huge market caps. And so doing these types of scams and frauds are not going to happen with those big stocks like Apple, etc., right? Now, penny stocks are often not listed on major exchanges, which means, again, there's less regulatory oversight. And so that's something else that you want to consider. But another reason why I avoid trading penny stocks is because I am someone who I say, hey, yeah, it's fine to day trade or trade in the short term. That's fine. You could definitely do that. But one thing that we have to understand is that most likely you're going to become much more of a better trader when you trade names frequently. For example, one of the stocks I trade very often, I do invest in Tesla in the long term currently, right? Maybe that may change 20 years from now. Who knows with the future. I don't have a crystal ball, right? So I am an investor with Tesla, but I also trade Tesla in my short-term trading account, and I trade it very often where I get to pretty much understand the price action for Tesla, and with a few other stocks like Apple, Nvidia, Meta, Microsoft, right? A lot of these large cap stocks are stocks that are in my niche within where I trade very often, and so I get to understand the price action a little better. Now, when it comes to these penny stocks, they come and go so often where maybe you trade something and the next day it's delisted. The company doesn't even exist anymore. And basically, when you're trading penny stocks, you're kind of just running from different stocks day to day, and you don't really have that foundation of how the price action pretty much moves with the specific stock versus when you have a niche. I'm often one of the people that say, hey, just trade the same thing over and over again, and you'll really get to understand how it moves. And if you don't want to trade a specific stock, you could trade, index ETFs. For example, there is QQQ, which let's actually pull that up, which is a NASDAQ index ETF. And this is something that's pretty much pegged to the NASDAQ index. and you could trade this going up and down, and they actually have inverse ETFs where you could go ahead and trade SQQQ, where whatever NASDAQ does, SQQQ does the reverse. So if NASDAQ, if the NASDAQ is going down, well, SQQQ is going to go upwards, and it has a 3 times leverage aspect to it where it's actually going to go up by 3x. So if the NASDAQ falls down 3%, well, then SQQQ would go up 9% because it'd be 3 times 3, which is 9. For example, we see that from the opening of the day to its high, it did around 3.63%. And if we take a look at QQQ, which is just the regular NASDAQ, from the opening to the pretty much trout of today, it went down 1.22%. So you see that multiplier 3 take place. Now there's also TQQQ, which is basically the NASDAQ index ETF going long. So whatever the NASDAQ does, it pretty much emulates it, but does it at a 3x component. So just like how SQQQ does that, but in the inverse way, this will just copy what the NASDAQ does, but multiply by 3. So hopefully I'm not losing anyone here, but the purpose of me mentioning this is that simply you could, if you don't want to trade the same stocks all the time, right, and you want to find an even more simplified niche, you could just trade index ETFs. There's a few of them out there, right? And so I just think it's much more easier to trade something that you follow daily than having to hop over from penny stock to penny stock, because again, these stocks, they come and go, and so you're chasing new names all the time, and they may trade completely differently, and they're much more volatile. But again, at the end of the day, it's not that you can't trade these and you can't be profitable. Again, you could be profitable doing anything. You could buy a bag of chips and sell it and be profitable. It's not that it's impossible, but it's just much more difficult when it comes to penny stocks. That's just like someone trading out of the money options. Let's take a look at Tesla, and let's look at these out of the money options. People are looking for these lotto trades, but you have to understand that the likelihood of making money with a lotto, right? Let's think of like a lottery ticket. It's very slim, right? It's very minuscule that you're going to actually make money doing that. And when you're trading penny stocks or out of the money options, you're going to notice that, yeah, these options are very cheap. And if it goes from 2 cents to 4 cents, yeah, you made a quick 100% return. But the likelihood of that happening is very unlikely. Why? Well, you're buying something that's cheap. It's expected that it's most likely not going to win. If it was that easy that you could just buy something cheap and make money, well, then of course everyone would be rich, and that's just not how the world works. Hopefully, I don't want to drag this video any much more longer. Hopefully you guys enjoyed this video. Hopefully you guys found some utility. And with that said, guys, I hope you guys make sure and hit that like button on this video, and also make sure to check out this video right over here where I talk about the 3 stages of a reversal. It's definitely a great video to check out, and I'll see you guys on that next video. Take care, guys.